Hey guys, Ken Boyd with the Accounting Accidentally website, where if you scroll down to the middle of the page, you can find over 400 videos on my YouTube channel here on the page. Slide down there. And also, remember that over at Patreon, I am creating subscription-only blog posts and videos that you can also join. So what I wanted to talk about today was an interesting article, and I'm going to go to full screen. This is about Royal Dutch Shell. And the headline that I saw in the Wall Street Journal was, "Groceries Prove a Pandemic Bright Spot for both BP and Shell." So they're trying to sell food and gas at gas stations to offset declining oil income. And this is a great point to explain. This is more information from the article. Gas stations have emerged as one of the most profitable parts of the major oil companies' sprawling operations during the pandemic, because they're selling food and drink. And it talks about at the bottom just how many retail sites these gas stations are opening. Pretty impressive. So this brings us to CostVolumeProfit CP Formula, which is one thing a CFO is battling if you're in the oil business. So we assume that X is the number of units sold. And the formula, sale price times X less variable cost times X, so per unit, less fixed costs in total dollars equals profit. And the difficulty with managing this formula is that oil companies must manage fluctuations in oil prices so that the sale price and the cost volume profit formula can vary a great deal. So just how much can it vary? This is a chart that shows West Texas Intermediate WTI, which is the most common measurement of oil prices. And if you look at the change in price per barrel, how it completely went to the floor when coronavirus peaked. You can see that even in 2019, the price was bouncing around between $65 and $50 a barrel, and then it absolutely hit bottom, and it started to come back up during the coronavirus crisis, which really puts pressure on the sale price component of the cost volume profit formula. So really tough to manage, which is why they're diversifying. Another thing you have to deal with when you're an oil company is capital expenditures, or CapEx. It's very expensive to take oil out of the ground and refine it, which gets crude oil converted or refined into gasoline. So you're spending tons of money on capital expenditure while at the same time you're trying to reward shareholders with dividends. If you go to the next slide, this is from a presentation from the CFO. They talk about reapportionment of near-term over $20 billion in cash capital expenditures. And at the bottom, they talk about maintaining an approximate growth rate in the dividend per share of 4%. So you are having to manage huge dollars of spending to get oil out of the ground, while at the same time figuring out how much of a dividend you can pay, which takes us into rates of return. Return on assets, net income divided by total assets. In the plumbing truck example is, imagine you're a plumber that owns a $30,000 truck, you're carrying $6,000 in equipment on the truck, and you're driving around doing residential plumbing. The challenge is, how much of net income can you get out of the truck and the equipment that you've invested in? And it's the same thing is true for the oil companies. Huge expenditures of assets. What return are you earning on the assets? And when we switch to think about investors, stock investors are really buying a flow of annual earnings, which is why price earnings ratio is such a popular metric. The stock price divided by earnings per share. What multiple of earnings per share are you paying when you buy a share of stock? So return on equity is also a huge consideration. Net income divided by total equity. How much are shareholders earning? What earnings are being produced for every share? And finally, dividend yield, the dollar amount of dividend per share divided by the current stock price. How much of that earnings pie are you paying to shareholders? And oil companies are trying to maintain a dividend while managing massive amounts of capital expenditure. So it's a challenging business. So that's what I wanted to cover today. And again, if I go back to this connection, you can see that on Patreon, here's my page. And if you have an interest in subscriber-only video content and blogs, you can go here. Thanks very much for watching, and we'll see you next time.